love the channel and find it useful in becoming a happy retiree. Subscribe today. George from Norcross. George, good morning. What's going on?
Good morning. After 27 years working on the nights, I decided to retire last year in October. And I moved my money from 401k, about $360,000 to Fidelity with advisor. And it seems like not just I didn't make any money, but I lose it. I should still keep the money where I have them, or I should move it someplace else or try something else.
Got it. Really important question. What George is really saying here is that, so in the fall of 2017, the world was grand and the market kept going up, and you retired. So you hired someone from, let's call it Fidelity, and it could have been anywhere. Fidelity, Schwab, could have been Merrill Lynch, could have been Morgan Stanley, right? And you signed up with an advisor, and you probably went over your goals and figured out what your retirement goals were, and you had a plan in place, I'm sure, hopefully. And then you figured out a strategy of, okay, well, how are we going to manage this money? And then you got started basically at the beginning of the year, and it probably looked pretty good for the first couple of weeks. And then now, here we are in April, and you're starting to question, George, why you did it. Because your account's probably lower today than where you started. Is that correct?
Yes, right. But I called them because it looks, how you say, it looks pretty good. Actually, we make pretty good money. And I called them and I said, look, I'm happy that I'm making money, but if the market is going to drop, I'm saying 30%, what's going to happen?
And then they didn't get out of so you were up for a little while and you stayed invested and now you're down.
Yeah.
All right. So this is important, George, because it's not, remember that the period of time that you and I we're talking about here is only about 3 months, January, February, March. And just remember that 3 month period of time, even though it feels like a long time, it's 3 months, that's only a blink of time when it comes to investing. It's a tiny, tiny bit of time. And really, you've got to take a look at the market. And if you think about it, we're net negative on the year for the S&P 500, the Dow's down, the NASDAQ's down. So if you look at stock-based indices, it's been a pretty bad quarter. It's been the first down quarter we've had in a very long time. With the S&P close to today about 8 or 9% off of its high, and you got invested kind of right near a high. So it feels as though things are wrong, and it feels as though you might need to make a change, but you've got to start really trying to put the time that you've got in perspective. You're going to be in retirement, George, God willing, for 20, 30 more years, and now we're talking about only 3 months. It has probably a lot less to do with the advisor or the strategy that you're using, and more with the realization, and I'll just remind you and remind everyone that we're going to have these periods where you're down 3%, 5%, 10%. That's part of investing in equity-based markets. Now, if you're 100% in bonds, you wouldn't be seeing that, but I'm sure you've got some stock component to your longer term strategy. And if that's the case, you just remember, as a reminder, you're going to have periods of time like this where it's not straight up like an escalator. It doesn't climb a steady 0.5% a month or 1% a month. It's going to be choppy and it's going to be frustrating. And that's part of investing. So just a reminder that, again, 3 months is just a blink in time. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.